Today, pop goes the property investor. Hi again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and property news. Well, in my surveys, one of the things that I've been observing is a number of property investors who are leaving the field. In fact, if you go back a couple of years compared to today, something like 20% of investment properties have disappeared from the marketplace. And of course, there are a series of reasons for that, not least the fact that the costs of running investment property are rising considerably because interest rates are rising, whereas rents, whilst they are rising, are not rising enough. And many people who are holding multiple investment properties have actually been shedding some of those properties. And another reason, of course, as I've discussed with Edwin quite recently, is that there's a whole bunch of new legislation coming in requiring further additions and modifications to investment properties, things like smoke alarms and other factors, which makes it much more expensive to manage the property. And the final thought is that, of course, property investors on a cash flow basis hardly ever make very much at all, but hope to make significant capital gains. And capital gains, of course, rely on home prices growing. Well, they haven't grown much over the recent times. And as a result of that, the whole investment proposition has changed for the worse. Plus, of course, now with interest rates at much higher levels, it means that you can look at alternative returns from term deposits or other investment products that actually provide a more secure return than property investments. So no real surprise to see that things have actually turned pretty pear-shaped. But the impact of that is, of course, that less rental property is available, one of the reasons why rents are actually continuing to rise, and vacancy rates are pretty low. Now, last week, Phil Lowe actually mentioned this in an address at the press club. And from there, I want to then go through some of the details around this rationale as to why property investors are leaving the field. Let's start with Phil Lowe's comments. Bank of Australia Governor Phil Lowe warned that not enough homes were being built to house an influx of migrants, predicting that rents will continue to rise in a further hit to household budgets. A major driver of inflation, actually, is the rapid increase in the costs of renting a property, which is the second largest component of the Consumer Price Index. Advertised rents have increased by 11.5% over the last 12 months, according to SQM research, while just 1% of rental properties are available for lease. According to experts cited in the AFR, a lack of investors is partially to blame for Australia's rental crisis, while investors already in the market are struggling to hold on to their rental properties because of soaring mortgage costs. The rising interest rate environment has deterred investors, and that's compounding the current strain in the rental market, said CoreLogic's research director Tim Lawless. It is definitely harder to hold and hard to add to a portfolio due to the tightening of borrowing criteria, said Margaret Lomas, veteran investor and mortgage broker at Destiny Financial Solutions. The banks are making it incredibly hard to borrow once you get past 2 or 3 properties. And recent analysis from CoreLogic showed that mortgage payments have risen at a much faster pace than rents. In Sydney, for instance, rental income has increased by around $340 per month over the previous year, but monthly mortgage payments on a $500,000 loan have increased by around $1,113 based on a 5.78% interest rate over a 30-year loan term with principal and interest instalments. Rents have increased nationwide by $227 per month, but monthly mortgage payments have increased by a far higher $904 per month. In fact, 100% of suburbs with house rental markets and more than 97% of suburbs with unit markets in Melbourne and Sydney are now cash flow negative, according to CoreLogic. And these rental losses are forcing investors to sell, with property investors accounting for more than 30% of homes for sale across Australia, up from around 20% previously. In the short term, investors will face further financial pressure as the tide of borrowers who took up cheap fixed-rate loans over the pandemic reset to variable rates that are double or triple their present levels. And of course, there is also the possibility of another interest rate increase by the Reserve Bank of Australia, especially in the light of the employment numbers that came out this week. So the point here is that property investors are being squeezed out of the market, but that's putting additional pressure on those trying to rent because, of course, the supply is continuing to diminish. And that's at the time when migration has been ramped up, as I discussed in an earlier post. So this is yet another example of when the market is broken. So as a result of that, households will be unable to find places to live. Property investors will continue to leave the field. And, of course, the underlying issue is that when the private sector takes the heavy lifting in the provision of accommodation for people, then that's a real problem when the economics change, as they have done now. Structurally, we have a major issue here with the way that the rental system works. And by the way, it's not just in Australia, but in the UK and other places too. Essentially, the government, both state and federal, have walked away and left it to the private sector. And of course, the private sector makes commercial decisions, and that means sometimes exiting rather than staying. So if we're going to solve this problem, we need to think very differently about the way that housing works and the role of the rental system. And by the way, just upping negative gearing support or some other government support for the rental sector is not going to help. We need a root and branch review here of what's going on. Yet, of course, both state and federal governments look the other way because they know that this is a horrible, big problem with no easy solutions. And as a result of that, we can expect more economic damage to be done. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.